Welcome back to another episode of FPO&G, Financial Planning for Oil and Gas Professionals. This week on the podcast, Justin, we're going to kind of do a year in review, really talk about the last 15 months in the market and talk about what it teaches us and what we have to learn. I think, Justin, your impetus for this conversation was you've been having this conversation a lot with clients. So it's a good time to kind of take a step back and be like, what's going on? And kind of it's some reinforcement ammunition, if you will, as to why we invest the way we do.
That's right, Jared. I do think that every person should have some level of conviction as to why they're invested the way that they are. Now, that's an interesting topic in and of itself, because what if we talked about a lot, Jared, the vast, vast majority of people in America who have significant assets, the vast majority of them do not DIY their own portfolio. Most of them, heavy majority, hire an advisory firm. They hire a professional to manage their assets for them. And so why, if they're delegating that, if they are hiring an outside firm to manage their assets, why would they need to go through the exercise of building their own convictions on how they're invested? But I still think it's important. I think even if you're outsourcing this, even if you are hiring someone to manage your assets, you need to have a base level of conviction as to, one, do you understand how you're invested? Two, do you understand why you're invested that way? And three, do you have strong enough convictions that during moments of underperformance, are you willing to stick with it?
Yeah, I mean, I think, right, like it's funny because you hire an advisor to delegate, but there still needs to be a baseline amount of understanding. So part of it is like, hey, I know what I don't know. I'm going to put this off to somebody else, but you need conviction, right? Getting back to like last time we talked on the pod, like Berkshire Hathaway had bouts of underperformance. They've underperformed for decades, depending on which dates you cherry pick. And Warren Buffett's the best investor of all time. Both of those things are true, right? You can have a really good investment strategy that has bad seasons. And being thoughtfully diversified means there is going to be time that you're underperforming, regardless of what benchmark you use or what you're using to track. So, I mean, there is no return without risk, right? So, you're never going to have a portfolio that goes up always and goes up the same as everybody else's, right? So like it all ultimately comes down to, do I have conviction to stick with what I have, right? And again, I don't need to know all the inner workings of it, but your portfolio will have a down year. The stock market will go down. What convictions do I have that allow me to hold for the long term, right? Because really, we tell this to clients and prospects all the time. Bear markets will not kill you. That's part of investing. What will is being a net seller of equities during those bear markets, right? So what conviction do I need to have so that, I can hold on when inevitably things aren't going favorably? Because that's, risk is the price of admission. Risk is the price of admission.
And Jared, just like you mentioned, the origin of this podcast is we are having this conversation in May. And so as a firm, we have wrapped up our spring review meeting window. And so we've had a lot of these conversations over the past 1, 2, 3 months. We've been reviewing the portfolio with clients and just talking through what has happened in the markets. Now, one thing that I say in these meetings, and I'll say in this podcast, we are looking at effectively March 1 of last year up until kind of late May. So this is about a 15-month window. And the reason why I think it's just such an interesting 15 months is there have been a lot of things going on in the US. There have been a lot of geopolitical events internationally. And so it's been really interesting to see what have different markets done? What has the reaction been? And what can we learn from it moving forward?
Yeah, it'd be a really cool thought exercise. It'd be impossible to do this, but to get all the headlines for the prevailing 12 months ahead of time, and then get to create your S&P target. Because if you heard Strait of Hormuz being closed, if you heard tariffs, if you heard conflict in the Middle East, if you heard AI taking people's jobs, if you heard of basically all the FANG stocks eviscerating their free cash flow to invest in an AI build out that may or may not materialize, and some people are debating as a bubble, right? If you had all of those events and then you had to guess where the S&P or any stock market was in the next, over that 15 months, you probably wouldn't be even close to right.
Which I do think that's something that's worth saying on the front end, and hopefully we remember to repeat it at the end. The crazy thing about investing in a hyper-efficient market like our stock market is, Jared, it's impossible to know which stocks, it's impossible to know which sectors, industries, which parts of the market are going to win in a certain time frame. Now, The one thing you can be certain of, Jared, is by and large, whatever you pick as an investor, it's probably not going to be the single greatest performer. Technically, there are endless combinations of how you could allocate a portfolio. And depending on the window of time you're looking into, well, it could be oil and gas stocks are the winner. It could be just put all of your money, your entire net worth in NVIDIA could be the winner. Or it could be a well-balanced, well-diversified portfolio could be the winner. But in an efficient market, it's effectively impossible to know ahead of time what future performance is going to be. And so you, as an investor, have to come to the conclusion of what is the most sensible way to allocate funds in an unknowable market.
Yeah. I would even say, like, to take it a step further, like deviating from market weights, there's probabilistic underperformance, right? We've talked about this in the past, but like Best Inventors research, most stocks over their lifetime underperform the stock market, right? Most. So like, it's not even like it's hard. No. Probabilistically, by tinkering, you will create suboptimal outcomes. But I think it's important to kind of like talk about markets because, a lot of people will tell us, hey, I'm diversified. It's like, I own the S&P. It's like, no. S&P is 500 stocks in one country with a overweight to technology. And again, over the last 15 years, that has been remarkable. But That is no way in effect the global equity markets. And I love that we're cherry picking 3-1 2025 to this because it's going to like reinforce a good story. But that's the thing. Every year is different, right? And again, the last 10 years or so, there's really been what Meb Faber calls a bear market diversification. Owning anything other than U.S. technology has resulted in underperformance, right? So having any form of diversification has hurt you as an investor. But, what we're beginning to see is the tides change, right? And it's not because somebody knew that it was going to happen. It was just that's the way markets work. Regimes change, sentiment ebbs and flows. There's a catalyst that emerges, right? And we never know when or how and what severity. But these last 15 months are a case study. And just I'm kind of glad we're doing this because usually we do a year in review and we just kind of blew past that this year.
Well, I also think this is kind of a fun episode. We do talk a lot about specific planning topics like estate planning or tax planning or different items, subtopics of tax planning. This is going to be a little bit more of just pure investment portfolio review. And it's almost like a case study of if you were a client of Jared and I's, what would your meeting have looked like? Not, we're not going to go into the tax, estate planning, insurance segments that we would with a client, but just on the investment front, this will kind of almost be as if it was a review meeting on, hey, what has the portfolio done?
And we will talk about broad asset classes. We will not mention any tickers or weights. And as always, this is not investment advice. So consult your professional. Austin, Justin, so where do you want to start? Kind of just been painting the picture of, before we get to results, I think process is a good thing. So you kind of talked about this idea of teaching, hey, being globally diversified and kind of following, this. We talked about it on the podcast with Phil McInnes, evidence-based. What does that mean to you, and how should people think about that?
Yes. And so if I were to give a background of how we approach the markets, what our philosophy is with investing, it all started at the University of Chicago over the last 50, 60 years. A couple of Nobel Prize winning economists have come up with this philosophy, and it's been branded or termed evidence-based investing. And Jared, I think I want to try and describe and just explain evidence-based investing in the shortest amount of time possible. So try to do it in a minute. I would say there's two main points that I want to cover. So 1.0 and 2.0. 1.0 is that markets are efficient. Markets are so efficient that it is frankly absurd to try and guess or time the market. Markets are so efficient that a proper application or takeaway as an investor should be that you should aim to have low-cost passive exposure. Now, I want to pause right there. Jared, when I say low-cost passive exposure, a reasonable takeaway would be, if you're hearing this, you might think, okay, then I need to pick 4 Vanguard index funds, and that should be my portfolio. And I want to actually address that and say, that's a pretty good way to invest. Nothing wrong with that. That's really, I like that. We are in support of that philosophically, but it is interesting that, Vanguard Total Stock Market, if someone gives us millions of dollars in cash, Vanguard Total Stock Market will likely be the single largest position that we use, but it's still a minority position. The heavy bulk, the majority of our portfolio is not Vanguard index funds, and that's because of 2.0, the second point I want to cover. So the first point is markets are efficient. The second point is that we want to slightly tilt or overweight toward factors in the market that have historically proven to provide excellent returns. And so those factors are small companies, so putting a little bit more exposure in small companies relative to large, so small cap. Value is number 2, so putting a little bit more, a slight tilt toward companies where we can buy their future earnings at a more reasonable price than typically growth companies. Number 3 is profitability, so a small tilt towards companies that are more profitable than their peers. And then the fourth one is momentum. And so again, if I were to really briefly summarize evidence-based investing, 2 points. Markets are efficient, so have low-cost passive exposure. And then as you've built that foundation of low-cost passive exposure, slightly tilt toward factors in the market that have the potential for great returns.
Yeah, I would say, the 2 things I would add, it's quantitative in nature, right? What does data and research say about constructing portfolios? It's not based on manager. What does this person think about earnings, surprise, estimates? And there's no it's a static allocation, meaning I'm not buying into or out of the market. I hold these indefinitely, right? Knowing that over based on what long-term returns say, right? So I'd say those are kind of some key components. And then kind of what you said matter. The price you pay matters. On the investor side, what are my expenses? Because those eat into future returns. Because after tax, after fee returns, are the only ones you can eat. And then what am I paying for a company, right? How much are the earnings? Those things tend to matter over time. And it's interesting, man, because we've talked about this on previous podcasts, and we won't get into it here. Those general tenets are good. But the interesting thing about an evidence-based approach is evidence is constantly evolving. So there's this fork in the road of, is this noise or is this not noise, right? You talked about, hey, this school of investing was built decades ago, but there's constantly people debating the merits of it. Hey, what type of, so value as a factor, as a company characteristic, historically delivers superior risk-adjusted returns. How do you define value? People don't necessarily agree, right? Or how do you, what metrics do you use for momentum? So, it sounds way more scientific than it actually is, but hey, what does data and evidence say about long-term portfolio construction? And I think that the core tenets are keep costs low, own everything because, correlations are low and a small percentage of stocks deliver excess returns. And there are characteristics that increase your odds of success.
And Jared, I do want to make a point on this. It is possible to explore a tilt towards small cap value in particular, and your end portfolio could be very tactical and it could be very not passive. And I would say that is a problem. And so I think it's important if you're going to introduce factors in the way you invest. Point number 1 should be the dictator. And point number 1 is markets are efficient. We should have low cost passive exposure. And so it's not that, hey, you really like small companies and you really like value companies, therefore your portfolio is night and day different than the global market capitalization of all equities in the universe. It shouldn't be night and day different. These should be subtle factors, and you should still be a passive investor by nature.
Right. And a great way to check is number of holdings. There are 1,000 holdings. Okay, I own small cap with shading towards value stocks. If I own 50 positions, I no longer own the market.
That is a wild tactical bet. And I'm glad that you touched on that, because this term passive gets thrown around in investing a lot. But to define it, I think one of the easiest ways to think about it is when you have your portfolio, or if you're looking at an individual part of your portfolio, do you own most of the stocks in that index or part of the market, or do you own a small percentage? And so if you are S&P 500 is the most famous, well-known index. If you're trying to build out an allocation in the US large cap space, do you own pretty close to 504 stocks or however many are in the index today? Or do you own 40? If you own 40, that's a problem. You're not a passive investor at all.
And the same thing hits geographically, right? Like, okay, if I'm a passive investor, I own global equity markets, right? The US is about close to 70% of, or probably mid 60s with the recent run up in international. But, 2/3 is US markets, 1/3 is everything else. If you own 100% US stocks, you are not you're not a diversified investor. You're making one bet on one geography.
I do think it's really interesting. Jared, you made the point and you're right. If you just really allocated all of your money into US large cap over the last 17 years, you are loving your portfolio. That's been the source of just incredible returns. But there's also been, because of that outperformance, there's been a movement to say, hey, I should just allocate in US stocks. And I think one of the most common defenses that I hear for that is globalization. And so why do I need to own international stocks? After all, the S&P 500, all of the companies that comprise the S&P 500, they're doing a ton of international business. They're in Europe, they're in Japan, they're doing business in emerging markets as well. So why would I need to own an emerging market company index or Europe or Japan or anywhere else if the US companies are doing business there? And first of all, Jared, I think it's important to just say that is true. US companies are doing a ton of business overseas, and so there is some embedded diversification. But I want to bring up the inverse is emphatically true. And so, during the last year plus, it has not seemed sensible to be an investor in Europe. Europe has a lot of problems right now. There's a lot of different conflicts going on. There's a ton of demographic concerns. It is a terrible place to do business. Yeah, so I personally cannot think of any reason why I would want to go move into Europe and do business just in Europe, right? But what I want to challenge our listeners with, every European company knows what we just talked about. And they know it well, and they believe it too. And so if your rationale for owning just US is that US does business overseas, well, European companies have seen this over the last 20 years, and they are following the opportunity as well. And so they are doing business all over the place, and they're doing a ton of business in the US. I think an interesting example of this, we are recording this podcast in Fort Worth. I didn't really know this 5 years ago, but Alcon, which, a lot of our listeners may not even know what Alcon is. I believe it's the 400th largest company in the world, but it is headquartered in Europe. Their largest, and I might be slightly off on this, it's either their number one largest or close to their largest source of employees, and their kind of company biggest base is here in Fort Worth. And they do an enormous amount of business in the US. And so this is a European company. If you own the S&P 500, you will not have any exposure to this company, but they are doing a ton of business in the US. And this isn't just a spotlight on Alcon solely. This is true everywhere. Every company that is headquartered in Europe, they are following the opportunity. And so just like US companies do a lot of business overseas, a ton of European companies are doing business in the US and emerging markets. And so it is possible that you can have a company that, or an index in general, that is trading at a much more attractive valuation that is still doing a ton of business in the US.
Yeah. I mean, there's also like pointing to diversification, right? I think we'll get to the numbers of performance, but it's been a better year for emerging and developed markets than for the US over the past 15 months. Part of that story is currency, right? It doesn't matter just, okay, every country does trade, every company does global trade, or a lot of the big companies do. So you might get that right, but if currency negative impacts earning per share because you're on the losing side of the currency trade, like that impacts you, right? And yeah, there's other ways you could deal with currency. You can hedge, you could do all that sort of thing. But owning international equities is a great way to kind of diversify your currency exposure.
Absolutely. Great point.
I want to read two numbers, right? I want to read where were things at, early April in the heat of the sentiment, right? So and again, we're cherry picking these dates, but it's good lessons still here. So we did it, at the beginning of March in 2025. So by April 8th, a little over a month later, S&P was down 16%. Russell 2000 value, so small value in the US, was down 17.8%. Emerging markets value was down 7.5%. World value was down 11.2%. World was down 14.3%. And emerging markets total return was down 8.27. So S&P was down. The two worst performing of all of those were S&P and Russell 2000. I'm curious what thoughts or emerge. Are there any lessons or takeaways? Just, and again, I realize 5 weeks is nothing, but what sticks out to you as you look at that?
Even though 5 weeks is nothing, this same principle holds true in just about any time frame. Jared, there's a huge delta here. So Russell 2000 down almost 18%. Emerging markets, it did 10% better. And so that is a really wide delta. This idea that all stocks move in lockstep with each other, it's not entirely true in different windows. And that has huge implications if you're taking distributions for income from your portfolio.
And correlation really tells you how likely these positions move in step. It's not that there's like a severity component missing. All the stocks were down, but like the severity really matters. And the funny thing is, people think like, hey, how do I outperform over the long term in investing? It's not, I never have down years. No, it's over a really long period of time. I'm slightly more up on my up years and I'm slightly less down on my down years. Yeah. Right? So like really like that is how you compound wealth. It's not being up every single year. It's how do I smooth out the returns on the bottom and then maybe get a little more on the top, right?
If someone tells me they were up every single year, I would, bet a lot of money that they vastly underperformed. Because it meant that they went super safe in assets that will slightly go up.
Right. Or it's private investing and the mark to market is somebody that's just kind of discretionarily throwing, sticking their hand in their finger and just sticking in the wind. Yeah, I think the economy's blowing up, but I think our portfolio is worth exactly what it was last year. Let me update the marks. As I see that, I think, wow, there is, diversification matters, right? Things are correlated, but the severity isn't the same. But, sentiment was really bad at that point, right? And a lot of tax loss harvesting had to take place. And if you invested money at the beginning of 25, that was terrible. But since then, it's kind of insane. Like if you go to today, we're recording this mid-May, S&P total return is up 26.7%. Russell 2000 is up, 2000 value is up 32.6%. MSCI emerging markets value, and we'll share these charts, is up 53.1%. MSCI World Value is up 25.5%. MSCI World, so just not with the value tilts, up 28%. And emerging markets is up 54.1%. So a couple fascinating things here. The two worst, S&P was one of the worst performing stock markets. S&P and Russell are two of the worst of those mentioned. But 26.7% over this 15-month period is remarkable.
It's remarkable. Jared, I remember listening to multiple podcasts and different investment shows in late March, early April of last year. And it was pandemonium. There was a lot of freaking out. And this idea of, hey, this policy could rewrite how we think about investing in a huge way. And so it's pretty crazy to think that there was so much fear a year, 13, 14 months ago, and the return since at the height of that fear has been nothing short of remarkable.
Hey, the S&P is doing great, but it's not the darling that it was.
You mentioned world return. The single thing that brought world return down was the S&P 500.
And also, too, it gets back to markets. Like markets are very different, right? Emerging markets was up in excess of 50%. The world was up closer to 30, right? And also, we probably should dedicate a whole podcast to this, but I do think it's wildly interesting that ExxonMobil does not have emerging market exposure in their 401k plan.
Jared, there's a really big difference between developed markets internationally and emerging markets. And we've seen that in the returns. And so you're absolutely right.
Yeah. So I think, all in all, it's been remarkable, but being globally diversified has paid off. Right. And sometimes it pays off over the short term and sometimes it pays off over the long term. But really, it gets back to why do I believe what I believe? And how am I investing based on those convictions? Right. If you think about really distilling down why, the merits of the ideas of evidence-based investing, the goal is portfolio resiliency. Right. A lot of people have done a great job accumulating. They don't need to hit home runs. They don't need to annualize at 20%. A lot of them don't even know what to do with their money if you get 8% returns, the historical stock market. It's all about building a portfolio that maximizes for resiliency. How do I construct it to where there's a positive expected return over the intermediate, regardless of economic environment, right? And I think this is just a testament to that and the case for global diversification, understanding that not all companies, not all types of companies are the same. And nobody knows when it's going to happen, right? Because again, looking at the sentiment and having all of the data points of what's transpired over the last 13 months, these returns, I don't think anybody would have came to this conclusion.
And Jared, I do think it's worth pointing out, you could listen to this podcast and think that we are just making a huge commercial for international investing. I do want to say we're not. And our single largest position is still US large cap. And it is a wonderful market with some of the greatest companies in the world. So we are not trying to kind of move away from that in any way, shape, or form. We just want to make sure we have thoughtful exposure everywhere. And this last year has been a wonderful example that there are world-class, incredible companies all over the globe, and we want to make sure that we own them.
Yeah, we are not any more or less smart than the last year. Right? It's just that's the thing is we're just following we're diligent with our process, right? And there will be a lot of years where we're apologizing, and if we do this year in review, it doesn't make any sense to own anything other than S&P.
Jared, I also want to kind of bring in some of the prior years as well as this kind of window that we're looking at here. So really interesting when you think about investing, if you are an institution, if you're a family office, or if you're a family or an individual. However you are structured, whatever your situation and circumstances may be, on some level, you are probably taking distributions and you need income unless you're still working from your portfolio. And so I don't remember, it was maybe 6 months ago, we had a podcast on kind of institutional investing, and we attacked the idea of permanent capital, that for the vast majority of entities, there is no such thing as investing permanently without ever taking distributions. And the reason I want to bring up taking distributions from your portfolio, first and foremost, you want to do it in an extremely thoughtful way tax-wise, but we are looking at portfolio performance with huge delta in different parts of the market. And when you're taking income from your portfolio, that's a feature. It's not a bug. And so over the last, handful of years, there have been some years where the S&P 500 has beat small cap or international by a significant margin. And then this year, this past 13, 14, 15 months, it's been the opposite. Emerging markets with returns over 50%. So the returns have, effectively been double what the S&P has done during this window that we're looking at. That's a feature when you're taking income, because as asset managers, it gives us so much flexibility in terms of which part of the portfolio should we take income from this month, this quarter, this year. And so you made the point about resilience, having different positions that are moving at different velocities. That's a superpower when you're taking income from your portfolio.
Yeah, and selling those is embedded risk management, right? Like if I just bought the global equity portfolio, every single country, and then didn't rebalance it and just walked away, I would have woken up 10 years ago, or I'd wake up today really happy because my portfolio has done remarkably well, but probably have close to 90% of my money in US. And so, as opportunity presents itself, it's a great time to rebalance and kind of risk manage.
Great point, Jared. Final point that I want to mention, as an asset manager, whenever you're looking at a window where there were parts of the market that are up 50%, my gut goes to, okay, is that now a bubble? Is it now overvalued? Do we need to rebalance out of it? And while we certainly want to always have, proper rebalancing rules within the portfolio, as a general idea, small cap within the US, international, emerging markets, these are not overvalued. In fact, they probably need to double or triple from here to get into the kind of realm that the S&P 500 is in.
Yeah, there's a Meb Faber podcast, and I can't remember which one it was, but valuation is the amplifier when a catalyst emerges. And he had a guest on and he talked about that. But so valuation, right? Like it doesn't really matter in the short term, but when things are selling and there's panic in the streets, valuation really tends to matter. I think, we have no idea how long this is going to persist, right? And I think the wrong conclusion is, it's overvalued. I mean, depending on which metric you're using, the US market has been overvalued for 5 years. And this, post-COVID to today has been one of the best 5-year periods in the S&P's history, right? And it's historically overvalued. So I think valuation, it needs to be a consideration for long-term investing, and there's kind of a mean reversion over the long term. But over the short term, if you think about the dot-com bust, things were overvalued in the mid 90s. And then it was a 5 more years of excess performance before things came off, right? So it's, things feeling overvalued or returns being really good and consolidating. Prudent risk management needs to happen, but that in no way, shape, or form means over the short term, things are going to mean revert. I love talking about portfolios. I know our clients do too. And it's awesome to see diversification paying off, right? Because it's like, it's been all US, all growth, all tech. And again, we still believe in all those things. And being a globally diversified investor overweights you to those things. But it's nice to see, portfolio resiliency beginning to manifest itself.
Right. And we'll repeat that same idea. No one has any idea which parts of the market are going to take off over the next 6 months, 12 months, or beyond. But this really is the most sensible way to approach the markets.
Awesome. Well, that's all we got. Ideas for future episodes, feedback, future guests want to be on our podcast. Love hearing from our listeners. Podcast@brownleewealthmanagement.com. Thanks. We'll see you next time.